Hi, thanks for joining me for another Coffee with Alissa video. Today, one of our retirement solutions advisors, Tyler Brose, will be joining me to answer some frequently asked questions about retirement plans. How are you today, Tyler?
I'm good. How are you?
Good. It's good to see you.
Yeah, thanks for having me.
Absolutely. So we'll get started with the first question. What is an employer-sponsored retirement plan, and how important is it to be saving for retirement?
Yeah, so what I tell people is think of this as a way for really to save for retirement directly through your company, right? So you get to decide how much you want to contribute through regular payroll deductions, and ultimately it'll come out and go into your 401k or 403b account right off the bat as soon as you start. Think of this as kind of not so much as a checking and savings account, but more so as a long-term vehicle for you to save. So not necessarily where you're putting money in and taking money out regularly, but kind of the piggy bank in the corner of the room that you're not really accessing. And to hit on your second question about why it's important to be saving, everybody pretty much wants to retire at some point in their life, and with people living longer and longer now, it's important to accumulate a nice nest egg that potentially needs to last us 25, hopefully 30 years into retirement, if not longer. So it's important that we save as soon as we can and as much as we can, and take advantage of some of that compounding, but also kind of that automatic deductions and ease of use within the retirement plan through your employer.
So how much can you contribute into a retirement account that's sponsored by an employer?
Yeah, so you can do in 2022 up to $20,500 if you are under the age of 50. And if you are over the age of 50, you can do a catch-up contribution of another $6,500. So in total, if you're over the age of 50, you can do $27,000. If you're under 50, you can do $20,500. And for anyone who maybe does not have an employer-sponsored retirement plan, if you are using an IRA, which is an individual retirement account, you're able to do $6,000 in 2022 with an additional $1,000 catch-up contribution. Again, if you're over the age of 50.
That's great. So regardless, whether you're contributing the $6,000 to an IRA or $27,000 to some type of employer plan, I think between the tax deferral and the fact that you're dollar cost averaging, that compounding could really have a huge effect in the future if you start planning and saving early.
Yeah, without a doubt. And it is important, like I mentioned. It's really, you want to get it started as soon as possible and be contributing as much as possible from a young age to take advantage of that. And really, how much you can do is really going to be dependent on your situation, how old you are, how much you've saved up to this point. And it's important to work with the retirement plan advisor to kind of help you determine how much you ultimately need to be doing. One of the things that I definitely try to help with our participants is making sure that you're aware of what your plan provisions allow, whether that plan allows for matching contributions. At the bare minimum, you want to make sure that you're at least doing whatever the match formula is to take advantage of some of those free contributions that your employer or benefits that your employer are offering. So we definitely want to do that and take advantage of those provisions.
And I think another thing to consider too, right, is do I contribute Pretax? Do I contribute Roth? Do I do a little bit of both? Can you talk a little bit about that?
Yeah, so some plans are going to have, most plans nowadays have the ability to do Roth contributions. Pretax, which is more the traditional route, have been around since the beginning of 401ks and 403bs. And it's really just dependent on when you're going to pay the taxes on those contributions that you put in to your retirement account. It is important to consult with your accountant or your tax advisor on making these decisions and becoming comfortable with them. But essentially, if you choose to do the pre-tax contributions, you're going to get a tax deduction in the current year that you make those contributions. And later down the road, when you get to retirement and you start taking money out of these accounts, you're going to pay tax at that point in time based on your income tax bracket at that point. On the contrary, if you do what's called a Roth, ROTH, contribution, you're essentially getting taxed on those contributions in the current year, so you're not getting that deduction. And then when you get to retirement, assuming you meet the requirements of being retirement age and the account has been open for 5 years, the money that comes out at that point at tax-free. That's the contributions plus any growth that you've accumulated at that point. But it's important, like I mentioned, when deciding on whether to do pre-tax or Roth, to really consult with your accountant. They'll be able to help you figure that out in determining that. And going back to your prior question, Alissa, is how much you can contribute. That $20,500 or $27,000 if you're over the age of 50, that is regardless of whether you do pre-tax or Roth. Those limits are in combination, so you could theoretically split half of your contribution to pre-tax and half of it to Roth if you wanted.
With these accounts, they're obviously for retirement. They're meant to be long-term savings, but there are times people might need to access it either while they're working or maybe they leave their employer and they're curious, what do I do? So can you talk a little bit about how it's a retirement account versus a savings account, like how distributions work, and even loans, which are pretty typical in 401k plans?
Yeah, so ultimately, like I mentioned, these are for retirement. So there's going to be some restrictions on how and when you can access the money. But let's say that you do ultimately leave your current employer and you have a 401k plan or a 403b plan. You really have kind of three different options of what you can do with that. The first is if your new employer offers a retirement plan, you could roll that money over to that plan. Secondarily, you could roll it into an individual retirement account or an IRA. Or lastly, you could even keep it where it's at with your current employer. As long as your account balance is over $5,000, you're able to keep it with that plan indefinitely. But getting to some of the reasons why you're able to take money out, every plan is going to be a little bit different in some of the reasons why you're able to take money out. So it's important to understand what your plan offers. But some of the common ones are going to be whether you have an in-service distribution. So this would be for someone who is still working at their employer but of retirement age. Theoretically, you could start taking money out at this point in time, assuming that the plan allows for it. Other reasons, obviously retirement, death or disability, hardship, and this is IRS deemed hardships. That's not necessarily if to you and I, if our car breaks down, that might be a hardship, but the IRS looks at it, things like medical bills, damage to your primary residence, to avoid eviction, kind of big ticket items. And then lastly, like you had mentioned, talking about loans, this is really a way to get access to money without needing to take or be subject to any taxes or potentially penalties if you're under retirement age. And how they work is that you're able to take up to 50% of your vested account balance up to $50,000. And just like any other loan that you might have at your bank, there's going to be an interest rate attached to this loan. But within the 401k, if you take a loan, you're essentially paying yourself back that interest rate. It's not going to your service provider or your advisor or even your company. It's going back into your account. And you're able to decide on the term of the loan, the maximum term being 5 years. And one of the things that you can do with the loan in a retirement plan also is that it does not require any type of credit check or background check as well.
Shifting over into the estate side of retirement planning, beneficiary designations. They're so important when it comes to retirement accounts because retirement accounts do not flow through according to your will. So could you talk a little bit about the importance of those?
Yeah, so that's a very common question and a topic that I discuss with our participants is making sure that on a regular basis you are reviewing your beneficiary designations. This is in the event something happens to you, who do you want your account to be left to? Family, trust, whatever it is that you want it to be. And this is different than, oftentimes I get the question, well, I think I did this for my life insurance during open enrollment. That covers me for the 401k as well. It does not. It's a specific beneficiary designation only for the retirement plan. So make sure that you do have one designated, making sure that it is the right individual or individuals that you ultimately want to receive these funds upon your passing.
Great, Tyler. Well, do you have any final thoughts to share with us before we finish?
Yeah, obviously we covered a lot of different things, but definitely take advantage of reaching out to your retirement plan advisor for any help, resources to your specific question, specific situation. whether that's the investment options, how much to contribute, and even some of those plan provisions that we covered. Definitely use them as a resource for any financial planning needs you might have.
Thank you very much. You provided us with so much information. If people have questions that are watching this video, please feel free to email us at sdwealthmanagement@schneiderdowns.com. Any of your questions, and we'll be happy to pass them along to Tyler so that he can help you out. And on top of that, if you're an employer and you are looking for a retirement plan solution, please feel free to reach out to that same email address and we can connect you with one of our advisors to see if we'd be a good fit. Thanks again, Tyler.
Great. Thank you very much.